Will the bank collapsing in the United States, such as SVB, Signature Bank, and First Republic, have an impact on real estate and mortgages? That's what I'm going to share from my perspective in this episode. Thanks again for tuning in. Really appreciate you. Make sure that you like it, give it a thumbs up, and share it. Okay, let's get right into it. So as you may or may not have heard, we have had 3 banks collapse in the United States. We've had SVB, Silicon Valley Bank, Signature Bank, and First Republic Bank. And now we have Credit Suisse from Europe that has just been bought out by UBS for $3 billion. This is a major occurrence occurring in the financial institutions in the United States of America. Okay, so how will this impact us as investors? Well, I'm going to tell you how it's impacted thus far. We have seen over the last week and a half that mortgage rates have been trending down. Actually, the 10-year treasury has gone down about 50 basis points. The mortgage treasury is the indicator that mortgage lenders follow, and that's what determines whether rates go up or down for that day. Right now, on average, we've seen about a half of a percent, so 50 basis points we've seen on the 10-year treasury on the downtrend. So that's had, I suppose, a positive effect. CoStar just put out a report of how this banking crisis will impact lenders and bankers to get even more tighter restrictions when it comes to lending. That's how I think that this will impact us real estate investors. So I recently refinanced a 57-unit apartment building. And this was before all of this crisis. This was just interest rates going crazy, just mayhem out there. So picture this, we have an asset that we purchased for $3 million, appraised at $5.7 million. It's a no-brainer. We were asking for 70% loan to value. We went through 4 different banks. We have plenty of equity. We have plenty of liquid. We have plenty of cash. And the banks were afraid of that deal. The banks were looking for reasons not to do the deal. As a matter of fact, the bank that we did close it with created a hurdle for us for another 4 months after we closed, that they wanted to see consistent cash flow coming in from the rent before they give us remaining of our cash out refi. I share this story to tell you that this was before Silicon Valley Bank failed. Now that we have all of this craziness happening in the market, because we are in some really weird times, guys. I believe we are in a recession. I believe we've been in a recession since July of last year. We've had 2 negative consecutive quarters of GDP, which equals a recession. We've been in a housing recession most of last year. For certain, for the last 12 months, we've been in a housing recession. And of course, this administration is saying we're not in a recession. That's a whole other topic. Anyways, back to the topic at hand with the mortgages and how this will impact. So this is how I see. I do agree with CoStar's article that there will be even more tightening. Right now, we have office space and retail space, real estate suffering, getting hammered right now. We have Blackstone that missed a payment on a $500 million loan that they had. I mean, Blackstone, one of the largest institutional investors in the world. And when you start seeing things like that, guys, you need to be really paying attention. Something big is happening in the financial markets. Will this have an impact? Absolutely, 100% in my opinion. I think we're going to go back to 2011 times. The difference with 2008, I was the guy in 2008 that was giving out those loans, that was doing those loans. I was a mortgage broker that was doing those ninja loans. We're in a different scenario. In 2008, we had a crash that was a subprime loan crash. And let me tell you what we were doing. We were giving 80-20 loans. So I would have someone come with a 580, 520. I remember 520, 550 credit score. Come in. We can't give you a fixed loan, but we'll give you an 80-20 subprime loan. That was, we'll give you a first loan at 80% of the purchase price at 9.25, let's say. The second loan of 20% of that balance of 20% at 11.5%. And they both reset in 2 years. When those mortgages started to reset at higher rates, with the values of houses going down and people couldn't refi, and the money tightened up and the banks weren't allowing people to refinance, that created a major problem within the financial institution. Right now, the banks learned from that. They did not lend that way since 2011, 2009. So now there's only A prime loans out there. There's only A-class loans out there. So we're going to see something different this time around. However, what we are going to see is that we're going to see bankers getting more stricter with their rules and with their criterias in order to qualify to get a loan. So we're gonna start seeing loan to values go down even more. I saw that when I was refinancing just a few months ago before this happened. In addition to that, we have people making a run on the money, right? Going to the banks. I think that scare is kind of down now. I think B of A got something like $15 billion in deposits, people taking money out from their small banks. Don't quote me on that. I can't remember if it was 15 or 12, it was somewhere in that. I think that in terms of the credit and the finances and the availability of money is gonna get tighter. That is of major importance to us investors. Why? Because the biggest lever we have in real estate is the leverage, right? Is that we can take a little bit of money and buy something that creates a lot of cash flow. We could buy a $3 million property with only, I don't know, 300,000 or 600,000. What you can see is banks are going to say, hey, we're going to now require 60,000, 70,000 of your money. We'll still leverage you, but they're going to require more money. They're going to require better credit. They're going to require better income. They're going to require longevity at work. They're going to create all of these additional barriers. I think this is how this is going to trickle into the mortgage lending side and how it's going to trickle, which is going to directly affect us in the real estate sector. Those are my 2 cents on that, guys. Do me a solid, drop your comments. Let me know what you think. If you think that you see a different perspective or you think that you totally think differently and disagree, let me know too. I'm cool with that too. I love to hear your perspective, guys. Again, thanks for watching. Thanks for listening. Really appreciate you. Again, peace out and thanks for being here. Hey guys, thanks for watching this video to the very end. If you want to continue to watch videos like this one, click this video right here. I think you would enjoy that. And if you want to continue to learn from me and learn how to create wealth through real estate investing, check out my online course. It's in the links below. It's how to get your first off-market deal in under 60 days or less. Thanks again for watching. Really appreciate you guys. Peace out.